Welcome to your ultimate pit stop, Piston Pundit. Let's dive into the world of automotive updates. China's economy and its once thriving automotive market, which peaked in 2017, are both hitting the brakes. The growth of electric vehicles has significantly decelerated over the past year, leaving EV manufacturers grappling with unsold cars. The market is saturated, and even industry leaders are feeling the pressure. So, fasten your seatbelts as we delve into the factors behind BYD's sales crash amidst this challenging market scenario in China. The February Fumble of BYD. The Chinese EV industry, once a powerhouse, is now grappling with significant challenges. Oversupply, fierce price wars, and production cost issues have led to a steep decline. Even industry giants like BYD are feeling the heat, with sales plummeting by 40% in February from the previous month. While February is typically a slow month for China, this year's sales drop of 37% compared to February 2023 signals a worrying trend. BYD, once touted as a potential rival to Tesla, is now facing its worst sales record since May 2022. Despite boasting advanced battery technologies and a strong presence in the plug-in hybrid market, BYD's sales have dropped significantly. Last month, it sold around 66,000 units, a 34% decrease year-over-year, and a total of nearly 122,000 EVs and plug-in hybrids, marking a 36% year-over-year decrease. The road ahead for the Chinese EV industry appears challenging. The domestic market dilemma. The global slowdown in EV growth is particularly pronounced in the saturated Chinese market. Oversupply and domestic market constraints have led to full dealer lots and price cuts to stimulate sales. BYD, a major player, is not just boosting sales but also outmaneuvering competitors. However, BYD's over-reliance on the domestic market, where it sells 95% of its cars, is a significant misstep. Despite its global recognition, advanced technologies, and impressive sales and production capacity, BYD's expansion into foreign markets has been limited. Its recent accolades and entry into markets like Australia and New Zealand have had little impact. In Europe, despite a plethora of models, BYD has struggled to establish a foothold due to its high EV prices. With the Chinese market also slowing down, BYD, like other EV manufacturers, is feeling the pinch. The company's decision to buy back its shares, at an expected cost of around $55.6 million, is a clear indication of its efforts to protect shareholder interests and boost investor confidence. BYD's decline, a mirror to the Chinese EV market. BYD's decline is not an isolated incident. The entire market is currently in a slump, an expected outcome after years of explosive growth. At one point, electric vehicles and plug-in hybrids accounted for 37% of the Chinese automotive market, but it seems the days of such rapid growth are behind us. For several consecutive years, plug-in vehicles doubled their market share. But in 2023, that growth was limited to 46%, and indications are that 2024 will be even slower. This percentage encompasses both EVs and plug-in hybrids. When we focus solely on EVs, the picture is even grimmer, with year-over-year growth around 31%. As a result, EVs now make up 25% of the total market, while plug-in hybrids account for 12%, thanks to a massive 80% growth over the past year. This surge in plug-in hybrids is telling. It suggests that Chinese consumers are not ready to completely abandon internal combustion engines and are still seeking transitional solutions. Plug-in hybrids, being cheaper and more convenient than EVs, are an attractive option. Consequently, it's likely that EV growth will continue to decelerate in 2024, mirroring trends in the rest of the world. Before we delve deeper, kindly hit the like button and subscribe to our channel. Your support enables us to connect with more enthusiasts like you. Now let's shift gears and explore the next segment: the Chinese EV industry, a fading star. The Chinese EV industry, once a high-flying rocket, is now a falling star. With over 500 registered EV manufacturers at its peak, even for a country as vast as China, this was an unsustainable number. In a few short years, this figure has dwindled to around 90. However, this number doesn't accurately reflect the current state of the Chinese EV industry. Many of these companies are barely moving any units. Some sources suggest that a third of these remaining EV manufacturers sell fewer than 500 cars per quarter, making their future prospects bleak. Simply put, the market is oversaturated, and with the current slowdown, it's clear where this is heading. Industry experts predict that many of these companies will soon declare bankruptcy. It's believed that only a select few EV manufacturers will weather the storm, considering that the top 10 sellers currently hold 80% of the market. According to the same data, only 20 companies operate at 60% or more of their production capacity. The wave of bankruptcy has already begun. Bankruptcy, the new norm for Chinese EV startups. As we've noted, a wave of bankruptcies is sweeping the Chinese EV industry. This trend, already in motion, has seen several prominent companies file for bankruptcy. A prime example is Evergrande New Energy Auto, part of the massive Evergrande Group. Despite vast resources and billion-dollar investments, it failed to establish a market presence or achieve significant sales. In fact, it lost $17 million on every EV sold during its brief existence. Other companies, like Letton, which once outsold Tesla, have also declared bankruptcy. The list continues with Neutron and WM, both of which have filed for bankruptcy despite impressive technological achievements and substantial starting capacities. Lastly, there's NIO. Despite selling over 50,000 units in the fourth quarter of 2023, it's still far from profitability. The company lost around $2.9 billion last year, and the outlook for 2024 doesn't look much brighter. The Chinese EV industry is indeed facing a challenging road ahead. The dawn of consolidation. The time for consolidation in the Chinese EV industry is upon us. With around 90 EV makers left in China, most are operating below their capacity. Only 20 companies use 60% or more of their production capacity. The market is saturated with EVs, and supply significantly exceeds demand. The top 10 EV sellers account for 80% of the Chinese EV market. Despite current struggles, BYD still holds a dominant position and is followed by a few other reputable names. These companies will survive, but the rest are heading in the same direction. The survival strategy for smaller EV makers is to merge, so we anticipate seeing numerous mergers and acquisitions soon. The Li Auto CEO has warned the government to act to prevent a wave of bankruptcies. We mustn't overlook Chinese legacy car makers like Geely and MG. These companies operate successfully in various markets and are important players in regions like Europe and Australia, enhancing their prospects for future growth. Thank you for tuning in to Piston Pundit, your ultimate pit stop for vehicle updates. Don't forget to subscribe to our channel to stay notified about the latest vehicle updates and upcoming videos. See you in the next episode.